Hi guys, Anandu again here. So when I made my last two videos on insurance, basic requirement of insurance and all those details, few of the questions I got from my friends is actually like how to calculate what is the sum insured requirement for somebody among us. So I actually made a mock sheet which depicts a story of a couple called Raju and Radha. So I will take you guys through this story so that at the end of the story, you guys will be able to kind of replicate your own term insurance sheet and kind of get enough term insurance so that your life or I mean your family is safe with respect to financial obligation with respect to any kind of unfortunate incidents. So let's come to this sheet. So the story begins like this. Raju and Radha is a couple and they have a small son, like not more than 5 years old. So their monthly income, let's discuss their financials a bit. So monthly income, Raju's income is around 1 lakh and Radha's income is around 40,000. And usually their monthly expenses comes around 1 lakh 10,000. And they have a current savings or investments around 20 lakhs. That's written here. Now we are making this sheet in order to calculate Raju's insurance need. Okay. So when it comes to Raju, his income is 1 lakh, and suppose on an unfortunate incident and Raju is no more, basically this income is no more there, right? No, so we need to kind of calculate the gap that would fill the expenses. So they have 1.1 lakh of expenses and Radha's income is around 40,000. So the gap between their expense and Radha's income, because Raju is no more, is 70,000. So this is the gap we need to fill. And apart from these expenses, there are some other major expenses this couple would expect. That is their son's education. That's at 25 lakhs of rupees that they're expecting. And all these numbers I am telling is in today's terms. Okay, like they're expecting as of today, 25 lakhs would be for a future date, it will be adjusted for that inflation. Okay. So since marriage, they're expecting 15 lakhs of expenses and they're expecting to buy a house, which would cost today 70 lakhs. So total for all these expenses, they're expecting a 1.1 CR of future expenses, okay, that they would meet through their combined income. Now coming up to these details of Raju's age, which is 35 years, Radha's age like 34. So on an average, they are like couple is 35 years old and combine their life expectancy is around like 85 years. So another 50 years. So when you're actually calculating your insurance need, one key terms comes into that. That's something called a safe withdrawal rate for this many years. So the years comes around 50 years, like that life expectancy of the couple. So I have made another sheet which actually shows how to kind of evaluate safe withdrawal rate. So let's look at this sheet. Mm, yeah. So this sheet actually gives a detailed mock-up of 50 years, next 50 years. And suppose like this sheet doesn't is not applicable to Raju's Radha's case, it is applicable to all the cases. So I am taking a test amount of 100 rupees here over these 50 years. So let's assume it's 100 rupees and your requirement for that year is 4 rupees. That's a 4%. Okay. So I'm assuming 4%. And if you subtract that 4 rupees from 100, it's 96. And this 96 you are able to kind of generate a return over the long term. I mean, per year, 11% of annual return over long term. So I think that's a decent expectation over long term if you are like going even for index funds. So 11% of return seems to be like okay assumption for me. So this calculation actually shows you what are the balance each year after deducting kind of a 4% of a expenses. Um, So after 50 years, what is happening is, if you look at like after 50 years, like you have around this much, like a 1,386 rupees left, which in today's terms is around 47 rupees. So I have like discounted it with a 7% rate, which is the expected inflation, decent assumption for an expected inflation over the of next years. So 7% of inflation is what we expect. So even after 50 years, almost half of that amount is still left, and that can be kept for their son, like for the next generation, right? So that's a decent assumption. So now let's come back to the insurance calculation for Raju and Radha. And main thing to note here is we kind of took an assumption of 4%, and 4% comes about to be a safe withdrawal rate for this couple. Okay. Now what we would do is like, let's calculate the corpus required for each of these expenses. So we have a 70,000 expenses, which is like need to be met through the corpus that you get from, obviously from insurance once that unfortunate incident occurs, right? And you need another corpus for one-time expenses that they would have met through their income over long term. And you would have to adjust that for current savings or investments, right? So we just calculated, what is the rolling expenses that would be required to met through the corpus? So that would be this 70,000, which is a monthly expenses calculated for a year, which is multiplied by 12, and you divide it basically 4% in order to get the corpus that you required for that rolling expenses. So the whatever the 100 I assumed here will become this, right? So that's the basics of the safe withdrawal rate calculation. Now required corpus for their one-time expenses. Again, we already calculated it 1.1 CR. Now we need to add that together, and whatever the current savings of or investment that they already accumulated would offset to these expenses, right? So when we kind of sum these expenses, it comes around like 3 crore 20 lakhs. So 20 lakhs of investments they already have. So your insurance requirements comes out to be 3 lakhs, 3 crores 20 lakhs subtracted with 20 lakhs, which is 3 CR. So Raju would actually require an insurance of 3 CR, right? So many a times I've seen like many of my friends, many of my colleagues, or all these people kind of underestimate the requirement of term insurance, and they usually go with the like whatever the agent suggests, like, okay, go with 1 CR cover or like 1.5 CR cover, but that's not the case. You actually need to calculate how much of a term insurance you need when this kind of unfortunate incidents hits you, right? So I urge everybody of you to actually make a sheet of yourself and your family's income just like this, and basically calculate what is your term insurance requirement and get insured for that. Also, one more note, you actually need to reevaluate your requirements like at least in every 3 4 years, right? Because there could be some changes, and there could be chances that some of these expenses are no more there, right? Suppose in this case, Raju's son, he's like very, very ambitious guy who actually like got through everything and he secured a very good job, and he's no more dependent on these people. So at that point in time, they can actually like remove those expenses. Like he might be directly able to meet his own marriage expenses or maybe higher education expenses. So also one way to kind of go to your, how to approach your team insurance is like to making into little bit of buckets. So Raju can actually do this 3 CR of insurance into 1 CR insurance and another 1 CR insurance and another 1 CR insurance. And whenever in future, if the requirement comes lesser, he can actually stop paying for that maybe 1 CR requirement and keep the other 2 CR. So this is a basic calculation. I will attach this Excel also along with this video for your reference for you guys to calculate yourself. Thanks, guys. That's it for the day.